Hi, everyone, and welcome to our podcast series where we discuss essential topics for entrepreneurs considering immigrating to Canada through the Startup Visa program. And today we are diving into the Canadian taxation system. To help us navigate this complex topic, we are excited to have Michael Dutra, CEO of the Dutra Wealth Management Group. Michael, welcome, and we are thrilled to have you here.
Thank you for having me.
Okay, great. Let's get started. Michael, can you briefly explain the different types of taxes that exist in Canada and which ones apply to the immigrants with an open work permit and others entrepreneurs?
Well, in Canada, there are quite a few different types of taxes. So that's one thing to be aware of. I think anyone coming into the country, I think probably the most important type of taxes to be aware of, at least at the beginning, are going to be what your personal income taxes may be, as well as the corporate income taxes. And that's going to be income if you're either earning a salary or paying yourself salary if you are a business owner, and then as well as what the corporate tax rates are going to be if you are an entrepreneur and have a corporation. So just to give you a bit of an idea of we'll start with the personal income tax rates for 2024. And this is specific to Ontario, except many of the provinces are similar in what the tax rate is. But to start, I guess, on the high end, so the highest personal tax rate that someone in Ontario could be in is 53.53%. So what that means is every dollar you earn above $246,753. So if your salary or income is above that amount, every dollar you earn, you're paying 53.53% tax. Of course, that's on the highest end. Not all personal tax rates are that high. It actually starts at income. If you're earning below $15,705, there's no tax, and everything above that, the tax bill begins to increase. So it starts at 15% and 25%, and then it just really continues, in the 30s and in the 40s, the more you make. So we have a marginal tax system in Canada, which means based on the bracket you're earning, you pay tax for that specific amount. And then once you jump to the next bracket, you're only paying tax on that next bracket of income. So it doesn't, I think one misconception is if when you jump brackets to the next tax rate, all of a sudden all of your income is taxed at that higher amount. And that's not true. It's really in segments. So the more you work up the ladder, the set of stairs, that next dollar is going to be taxed a little bit higher with regards to the personal tax rate system. With the corporate tax rate system, now again, based in Ontario and depending on the type of corporation or industry you're in, generally speaking, most business owners are going to face a 12.2% corporate tax rate on income, net income below $500,000. So if your corporation is earning $500,000 or less net, you'll face most likely about a 12.2% tax rate. And if you're earning above $500,000 net income, it's going to be 26.5% corporate tax rate. So the corporate tax rates are less than the personal tax rates. So if you are a business owner, one of the things you want to look at is trying to keep your income in the corporation to reduce your tax rate and potentially only pay 12.2 or 26.5%.
Michael, do immigrants and entrepreneurs need to register as taxpayers? If so, when and how?
I thought it would be important to describe, and this is going to be directly off the CRA website, so I want the information to be as accurate as possible. It says who newcomers to Canada are. They may be permanent residents, which includes people who have received approval in principle from immigration, refugees and citizenship Canada to stay in Canada. It could be refugees, protected persons, and it could be temporary residents, which includes students, workers, and temporary resident permit holders. Now, again, this is what it says on the website. The Canada Revenue Agency considers you a newcomer to Canada for the first year you're a resident, and you become a resident of Canada for income tax purposes when you have what they consider enough residential ties, and that usually means the day you arrive in Canada. So that's a bit of a mouthful, but basically, uh, there's two reasons someone would kind of when to do your taxes. And one is if you have to pay tax. If you've earned any sort of income as a newcomer to Canada, 100% you need to file a tax return. You also need to file a tax return if you want to claim a refund. And a refund could be some of the benefits that the government offers.
And how do I do that? Is there a system for filing tax reports?
There's two options, really, two main options. One is you can just do your taxes yourself, or you can use a professional, which would be an accountant. I always recommend going the professional route. You can sit with an accountant and learn from them and get their expertise on really how to file, because you might have to file corporate taxes, you might have to file personal taxes. It can get very complicated, and especially someone new to the country, I mean, they may be missing out on some of the benefits and credits they're eligible for. So it's not just all about just filing taxes. It's the complete picture to make sure that if you are eligible for any sort of benefits, that you are receiving them, and an accountant would be the most experienced professional to help you and give you advice on that.
So, Michael, is there a practice in Canada where an organization pays taxes for employee? And if yes, which ones, what kind of organizations are those, and to what extent?
Typically, so if you, by organization, if you mean like the company itself, typically if you're a salaried employee in Canada, the company itself will remit the taxes on your behalf, or at least that's the most common way. And what that means is, as you're getting paid, hopefully it's net of taxes. So the company is giving the taxes to the government. So at the end of the year, you don't owe a big tax bill, receiving almost too much money and the taxes haven't been factored in. So that's a very common route as a salaried employee. As a business owner, it's different though. You tend to receive all of the money, including what should be, going to taxes, in your bank account. So you really have to keep some aside to make sure at the end of the year you haven't spent it, or you have at least budgeted to pay the taxes back. And typically in future years, the government will require you to pay, it could be quarterly installments of your taxes, a bit of a projection. And to be honest, it's a safer way to do it. So you're budgeting as the months go on, you're paying your taxes in installments, and nobody likes to be hit at the end of the year with like a bigger tax bill than they anticipated. That can really throw off a lot of people. So remitting it, it is probably the better way to go.
Okay, and again, about tax returns, how are they structured in Canada, and what platforms or methods are used to file them?
If you go with the accountant route, it's typically just a digital submission. So everything is done electronically these days. However, if you go to file yourself, there's going to be a different kind of upload system than what your accountant uses, but it can get complicated. So I wouldn't try and take too much on, especially as a newcomer. It's hard enough for a Canadian who has lived in Canada their whole lives to file taxes, never mind someone who's new to the system. So probably suggest getting some professional advice on that.
Okay, and what penalties exist for not paying taxes, or for late filing of the tax return in Canada?
There are quite a few penalties and interest charges if taxes aren't paid, and I'll read off the CRA website again. So it says interest and penalties on late taxes. You will be charged interest on any taxes that you owe if you pay late, and you will also be charged a late filing penalty if you file your tax return late or have a balance owing. And there's a variety of different amounts of penalties that is all listed publicly for anyone to see. For an example, there could be a late filing penalty of 5% plus an additional 1% on every full month that you file after the due date. And the list is quite extensive. So really, you want to make sure you're filing on time and not causing yourself, additional expenses and hurdles with the government.
Sure. Michael, how does the taxation system for a business change after an entrepreneur obtains Canadian resident status?
As far as I'm aware, no. Corporate tax rates are going to be the same. There may be some additional benefits that an individual may receive as a newcomer to Canada, but as far as the corporate tax rate system goes, it's going to be the same for everybody.
Okay, and are there any tools or strategies for tax optimization in Canada?
There certainly are. And you can look at the personal side of things and or the corporate side of things. So to start with, personally, there are different types of investment accounts that anyone is eligible to have, newcomer or Canadian resident. A tax-free savings account is a great type of investment account to grow your wealth and make investments in. There's RSPs. There are also non-registered stock portfolios as well. So from an account perspective, those are probably the main ones anyone looking to save for the future of retirement is gonna look at. We can also look at things like your principal residence. You have a principal residence exemption when you sell your home, so that's also a very tax efficient manner to possibly grow your wealth. Corporately speaking, you can make investments in your corporation as well. You can't have a TFSA or an RSP in your corporation. It would be typically a non-registered portfolio. But again, there's, depending on the type of investment you're making, you may be facing capital gains, interest income, dividend income. So there may, typically there's some tax somewhere in any sort of investment someone makes, but there are certainly planning opportunities to help minimize the tax bill. And as a business owner, you have the option to pay yourself salary, dividends, a combination of both. So working with a professional to really run the numbers to see what makes the most sense on how to pay yourself, and then what to do with some of the leftover money. Tax optimization is a wide range term that can mean a lot of things to a lot of people. You just really want to make sure there's no cracks in the foundation where you're paying additional taxes when you don't necessarily have to. You may be triggering what's called interest income because some of your investments aren't in a registered portfolio, and a simple transition could solve that problem. So speaking with a professional is certainly going to be your best route, especially for a newcomer to Canada.
Michael, thank you so much for your time and for sharing your expertise with us today. I'm sure our audience has gained valuable insights into the Canadian taxation system.
Thank you, Anna. I appreciate it.
And thanks everyone who watched this video, and stay tuned for more expert tips on navigating the world of business in Canada.